Welcome to the Real Estate Mentor Podcast, the #1 real estate mentorship podcast on the internet. I'm your host, Jonathan Klunk, realtor with eXp Realty, located in Louisville, Kentucky, but serving all 50 states with a short-term rental expertise. Today on the podcast, we are having a great discussion about the differences between FHA and conventional loans. This is a question that I am asked all the time, both by first-time home buyers, by seasoned home buyers, and by investors. Which loan product is exactly right for me, and what are the differences? So, things change from time to time. The qualifications and everything do not always stay constant. So I'm very happy to have with us today Alex Turner, good friend of mine. He is a loan officer at Interlinc Mortgage, serving a number of states, and he is going to help us determine the differences between FHA loans and conventional loans, and maybe help you decide which one might be right for you, whether you're buying your primary residence or investing in real estate. Alex, welcome to the podcast. Thanks for joining us today.
Yeah, thanks for having me. Really excited to be on with you today.
So we had a little conversation in preparation for this and uncovered some really good areas and also some scenarios that we want to run through to show the differences in what that monthly payment might be for people investing or buying real estate. Let's start by talking about some of the key differences between FHA loans and conventional loans. What are the top considerations?
Yeah, so I'd say, the key things, you're going to find a difference in the debt to income that you can go up to with each loan. Credit score requirements will be different. There are some appraisal differences with each. Usually FHA might be a little stricter. Your mortgage insurance will be calculated differently. But I'd say those are the overarching things where you're going to find key differences between FHA and conventional.
Okay. I mean, that's a lot of differences. That's almost every component of getting a mortgage. So let's dive into some of those individually. Let's start with credit score. So if you have a low credit score, I think it's kind of common knowledge that you would lean a little bit more towards FHA, higher credit scores more towards conventional. Is that a myth or is that a fact?
Nope, that is very much a fact. So there is the minimum with FHA, you're going to be looking at a 580. So you need a 580 at least credit score to be able to make a minimum down payment with 3.5% down. Conventional, it actually allows you to go down to 620, but like we've been talking about, really, unless you've got a score that's, at least in the high 600s or going into the 700s, conventional loans are not going to price out as well for borrowers like that. Unless they've got, I'd say at least 720 above that. That's when you really start seeing a difference and a positive with conventional loans compared to FHA. FHA is definitely going to be, more suited for your borrowers in the 600 credit range. So you'll find much better pricing with FHA for borrowers like that.
So you're saying that even if you have a credit score that does qualify for a conventional loan, it still might not be the best option for you when you're looking at your total monthly payment.
Right. Even though you still can qualify for conventional with a credit score in the 600s, just because you can doesn't mean that's the best option for you. And so, I think a lot of people look at FHA loans as sort of a first-time homebuyer program or, loans specifically for people with only credit in the low 600s. But really, FHA can still price out really well and be a better loan for someone, even up to 700 credit score. So it has nothing to do with being a first-time home buyer or, having really low credit. Even with decent credit, an FHA loan might still price out better.
And I'm glad that you mentioned first-time home buyer because I was interested to learn this for the first time. A first-time home buyer is actually considered to be somebody who hasn't owned real estate or had a mortgage for at least 3 years.
That's correct.
That's it. I think a lot of times people hear first-time home buyer and they think somebody who has never had a property whatsoever. But if you lived in Florida, you owned real estate there, you sold it, you've been living in an apartment or renting a house for 3 years, now you're looking to purchase real estate again, then you're technically considered a first-time home buyer. Is that both for mortgages and for things like government or state programs that are tailored towards first-time home buyers?
That's right. Yeah, that's going to go for, your regular conventional FHA mortgage, but also in considering, down payment assistance type options. A lot of those require you to be a first-time home buyer. So yeah, if you're someone who maybe owned a home 4 or 5 years ago, you sold it, you've been moving around a bunch and, have been renting in different spots, as long as we can confirm you've not owned a home for 3 years, then you are technically a first-time home buyer. And something to keep in mind with that is that it's not just if you've bought a home yourself before, it's if in any way, shape, or form you've owned a home. Like if you inherited a home, and you've owned that within the last 3 years, even though you didn't technically buy it, you did still own it. And so in that scenario, that person would not be considered a first-time home buyer.
So purchased and gifted real estate qualifies.
Yep.
All right. So debt to income ratio, I think, is a huge part of the real estate transaction because it essentially tells you how much you can borrow. A lot of times, if I'm working with people who have not gone through the pre-qualification process and spoken with somebody like yourself, they maybe have a good idea of what they can borrow. Maybe they have really high income, but they might not understand that how much they can borrow also takes into account how much debt they have on their credit report. So other mortgages, if they have investment property that's titled in their own name and shows up on their credit report because they're going to be essentially a personal guarantee on that. Your vehicles, probably some medical debt, student loan debt, all of this is considered. Tell us how DTI is calculated a little bit and differences between FHA and conventional, if any.
Yeah. So debt to income, there's two numbers we look at, two debt to income figures. One is just the housing payment, the new housing payment you're taking on. And then the second one, what we call the back end debt to income ratio, would be the new home payment, but also everything else considered that's on your credit report. So, all the car loans, credit cards, any sort of debt that reports to credit, student loans as well. And then also that can include things like child support, alimony, if there's any tax debt, paying back taxes of any sort where you have some sort of monthly payment, all that has to be factored in as well into that debt to income ratio. And so, yes, there are differences between FHA and conventional on how high the max debt to income is. With FHA, you're going to be allowed to go all the way up to 57%. That's the back end debt to income ratio. So the housing payment plus everything else factored in. And then with conventional, you're going to be a little bit more limited with debt to income. You'll only be able to go up to 50%. So that's another way where, sometimes even though someone can qualify for a conventional and they're well qualified, since that conventional mortgage limits them more, if they're wanting to purchase at a higher purchase price, then in that scenario, we might lean towards the FHA just because we have a little bit more room, to push that debt to income ratio above 50%. Okay. And 7%, that can make a large difference.
Right. That's what I was going to say. It's a 7% swing. So when you're calculating this debt to income ratio, essentially you take your top line revenue, which is, usually how much money you make. Is it after tax every month?
So that is actually a gross number. So whatever the gross amount of income before tax that you bring in, that's what we use to factor in debt to income.
Okay. And so then start with that number. And then we're going to deduct on a monthly basis any expenses that appear on your credit report. So if somebody goes and gets a free copy of their credit report from one of these online services, they can then go and see what they're reporting that their monthly payment is every month, deduct that, and then do a calculation to see what percentage of my monthly income are my monthly revolving expenses. And if it is 50% or less, they will qualify for conventional. If it's above 50%, but under 57, then they would more qualify for FHA.
Correct. Yep. So definitely, looking at that, making sure to factor everything in that's on their credit report, and then also including that new mortgage payment. So if you're trying to make those calculations, there's calculators online you can use. I'd say it's always best to go and actually speak to a loan professional and find out as accurate of possible estimation on what the new mortgage is going to be. Rates fluctuate a lot. Homeowners insurance can be priced differently in different areas. Taxes are different in different areas. So going to like Zillow or realtor.com or some website like that where it offers estimated payments, those are a good place to start to get a decent idea of what the monthly payment's going to look like. But yeah, definitely, it's important, I think, to talk to a professional to find out what a real estimate looks like, to make sure, interest rate is calculated correctly and mortgage insurance, if that's being included. And then, just throwing in every other liability that's popping up on the credit. And so say someone makes $10,000 a month, they have $1,000 of reported credit on their credit report between car loans, credit cards, whatever. So let's say they have 1,000 there, then they have a $2,500 mortgage payment that they're expecting to take on. In that scenario, we're looking at a total of 35% debt to income.
Okay. Of course, the lower the better, because that means that you're going to be able to afford your house and also have more money left over at the end of every month for all of your discretionary expenses and things that are not reported on the credit report. If somebody is over 50% or over 57%, I guess the thing that they need to focus on doing is paying down some of that debt so that they get under that number and then come back so that they can get qualified to purchase a home. How long after somebody pays that money down will they be able to be reassessed?
So immediately. And in a lot of cases, we'll have borrowers where currently they are over the max, whether 50% with conventional or 57 with FHA. So they might currently be over that max, but if we can plan in them paying off some accounts, say they have extra funds, then we can set it up to where they actually just pay these accounts off at the closing table to then get the debt to income ratio down. So that, there's really no waiting period. As long as we can find a way to get it paid off and the debt to income below the max before we close, then, no reason to wait.
Okay. Good information. So mortgage insurance, you talk a couple of times about that fluctuating. I understand that with FHA, it is fixed. It is 0.55% of the total loan amount every year. And with FHA, I learned this the hard way when I had an FHA loan. That mortgage insurance never leaves until you pay that mortgage off or you refinance maybe with a conventional mortgage later on. You are paying 0.55% of your total loan amount as mortgage insurance every month for the life of the loan. Now with conventional, you said that this is also going to fluctuate, and that could be calculated, based on a number of factors, and probably follows a little bit of a risk profile, I would say, for each individual. Let's talk a little bit about how much that can fluctuate. And then we're going to run through a couple of scenarios where we're going to see how that can actually impact your monthly payment.
Yes. So that's a big thing there. So with FHA, it is set. Whatever it starts out as, it's not going to change at all. But yes, you're right. It's never going to go away. With conventional, it is heavily dependent on things like credit score, debt to income gets factored in. How many people are on the mortgage can matter. Typically with two buyers, you're going to get a lot better mortgage insurance premium than what you are with just one. And so, yes, where it makes sense with conventional mortgages, where the PMI starts getting a lot lower is for those high credit score borrowers. And really, that's why we start leaning towards conventional when we find someone with 750 or 760 credit, somewhere in that range. We're going to go towards that conventional because for someone like that, they might be at 0.2 or 0.3% as opposed to 0.55% with FHA. But yeah, if you have a borrower with, credit in the 680 range, 700 range, for them, the mortgage insurance can start getting a little pricey. And that's where, again, we'd fall back to the FHA, is because sometimes the mortgage insurance for borrowers with credit in the 600s on a conventional mortgage can be 2-3 times what it is with FHA.
And that really adds up, as we know. One thing that we haven't discussed, I don't think that we really had on our list here, but I wanted to mention are the actual interest rates for FHA loans versus conventional. I feel like on a lot of calculators and daily lists that I follow that publish the most current interest rates, it always seems like the FHA rates are lower than conventional. Can you speak to that? Is that a true statement?
Yeah, a lot of times they are, it's a government backed program. So, they do tend, in most cases, I'd say, to have a little bit lower interest rate. And the biggest difference you see with that is, for a high credit score borrower, let's say someone that has 740 credit, or for a borrower that has 660 credit, with an FHA, you're not going to see a lot of variance in what their rates would be. You're not penalized so much with an FHA loan for having a lower credit score. But with a conventional, that's where you get penalized a lot on the interest rate for having a credit score below 700. That's where you're going to see a massive difference. So that's why, again, FHA tends to be the better option for lower credit, mid to lower credit score borrowers, because there's not such big hits for, lower credit on the interest rate.
Mm-hmm. Okay. Let's talk for a moment about investors. So a lot of people are interested in investing in real estate these days, and there are FHA loan products for investors. And obviously there are conventional as well, because majority of investment properties that I'm working with people on are going to be purchased through conventional loans. Outside of conventional, you have some limited loan products. You have a bank portfolio loan, which means the bank holds and services that. It could come at a higher interest rate or with an adjustable rate. And then you have commercial loans, which obviously do the same, but you're also limited sometimes to a 15-year amortization, which will make your monthly mortgage payment higher if if cash flow is important to you. So let's talk about FHA and conventional loans as they pertain to investors. So FHA, if I understand correctly, is good for a purchase of up to a total of 4 units under the same roof, so a fourplex, but it does have a requirement that the borrower needs to live in at least one of the units as their primary residence for a minimum of 1 year. Is that correct?
That's correct. That is.
Okay.
So yes, you can use an FHA mortgage to buy up to a 4-unit property, but it is required that you live in one of those units. So it has to be a primary residence purchase. You cannot buy a home as an investment solely with an FHA mortgage. For those, you have to use a conventional.
Okay. And of course, house hacks are very popular right now, moving into something where you have income from that property coming in to cover all or majority of your mortgage, and maybe even some expenses on top of that, really helps to set people up for success, especially first-time home buyers early on. Of course, you have to consider, do you want to live in an environment like that? It takes a person with a certain ability to handle all of that and to really have strong financial goals that they're working hard towards, for that to be palatable. From a conventional standpoint, we have a couple of scenarios. Number one is you can follow that of the FHA. It can be your primary residence, up to 4 units as well, I believe. And if you live there for 1 year, then you can essentially do a lower down payment. You're still going to have that 3% down payment if it's your primary residence for at least 1 year. Outside of that, if you're not going to live at the property, then you have a 5% minimum down payment, which is great because it used to be considerably higher than that.
Mm-hmm. That's correct. Yeah. So just recently in 23, they changed the rules on down payment for buying a primary residence with a conventional mortgage. That's 2 to 4 units. So it used to be, you needed 10, 15, 20% down to be able to purchase those, and it'd still be considered your primary residence, but they changed it to where now you only need 5%, just a 5% investment on the down payment to buy up to a 4-unit property. For first-time home buyers buying a single-family home, then yes, the down payment on conventional would be 3%. But yeah, buying a 2 to 4 unit, whether you're a first-time home buyer or repeat buyer, you're still going to have that minimum 5% down payment. But again, yeah, a lot less than what it used to be.
Mm-hmm. Yeah, considerably. I do remember people looking at duplexes and for investment, and even if they were going to live in a portion of it, it still had a 15% down payment, which priced them out of the market. They had to go FHA.
Yeah, I think, house hacking like that, that's one of the easiest, cheapest, lowest cost ways to get into investing in real estate. And so, yeah, I definitely, I love working with people when they're going after that. I think it's a really smart idea. If you're a first time home buyer and you're interested in investing in real estate on a $300,000 home, you can get into that with a minimum 3.5% down payment, which is going to be a little bit over $10,000. Whereas, if you're trying to go straight for investing, you're looking at minimum 20% down, to be able to do that. So for people just starting out, I think it's an awesome avenue to take.
Mm-hmm. Absolutely. So let's take a moment and go through payment differences because I was shocked to see this information. So we're going to be looking at the difference in a monthly payment for a borrower that has a 680 credit score, and they're looking at a purchase price of $300,000. So we're going to break this down for FHA and for conventional. So Alex, why don't you start by, we know the purchase price. We have some other information factored in here. Tell us what stays the same and what changes between these two loan types.
Yeah. So obviously, you're going to have insurance, property taxes, those are going to be counted in. So we're going to, keep those the same so we can really just get a look at the difference in the mortgage payment, the interest rate, and then the mortgage insurance. So for a 680 borrower, so we've got an FHA option, conventional option. So this is at 680, you're going to find quite a big difference in what the rates are on each. So again, going back to like where having a slightly lower credit score, it's not going to make a huge difference on an FHA. So at today's pricing, it's going to be with an FHA borrower 680 making a minimum down payment of 3.5%. That rate would be somewhere around 7 1/8. And I'd like to say this is in no way a quote. This is just, a general idea of where rates are for a borrower like this. So at this purchase price, monthly payment on that's going to be $1,985. I'm using a $150 estimate for the homeowner's insurance, a $312 estimate for the property taxes, and then the set mortgage rate or the mortgage insurance will be $135 a month. So that brings that borrower's monthly payment to $2,580. So that's their option with an FHA. Now this borrower trying to use a conventional, and I'm going to use, hypothetically using a repeat buyer. So they're going to have to put 5% down. So their interest rate would be at 7.625%. So that's 0.5% higher than what it was with the FHA option. So with that mortgage payment would be $2,060 a month. So that's a roughly $80 difference on just the mortgage payment. We're going to say insurance and property taxes, we're going to estimate the same, $150 and $312 a month. But then here's the other part that adds in a whole lot on the monthly payment is the mortgage insurance. So for someone, a single person with 680 credit score making this minimum down payment, their mortgage insurance with the conventional is almost twice as much at $253 a month. So that's $120 more on the mortgage insurance and roughly $80 more on just the principal and interest payment. So for that person with 680 credit wanting to make a minimum down payment, they're going to be better suited for the FHA mortgage, with a $200 a month lower payment.
Mm-hmm. Yeah. Two things stand out to me here. And number one is at a $300,000 purchase price, going up almost 0.5%, half an interest percent, only raises your monthly payment by $80. Not having a calculator in front of me, I would assume that it would be much higher than that. So for those of you who are, playing the interest rate game, who are afraid of the higher interest rates right now, obviously you can refinance at a later date. That does have some impacts as well on, the total amount of interest that you pay over the lifetime of owning that property. And we can have that discussion with you. But also $80 a month difference in 0.5. So 0.5 percentage point higher, only $80 per month. So not extreme by any means, but it's that mortgage insurance that really is what's getting you. I did the math here. For the FHA loan, you're looking at about little under $31,000 per year total payments all in. On the conventional, you're looking at $33,300. So with that difference of $2,388 that you save by going FHA, that's like getting a little over one free mortgage payment every single year. I mean, do that for 15 years and that is a lot of money.
Yeah, most definitely. Yeah, that's,
Okay, so next, let's skip ahead to a different borrower. So this is going to be a borrower who has a higher credit score, 780, still purchasing a $300,000 house. And we're going to look at the difference between conventional and FHA again and see what the results are.
Yeah. So for this borrower, in the high 700s here, the funny thing is with FHA, really not a whole lot changes. You have the same interest rate, you have the same mortgage insurance. So, again, going back to there being such little difference for a change in credit score like that, borrower with 680 and with 780, they're getting the same pricing on an FHA. So this is where the conventional comes in and usually prices out better. And in this scenario today, we're not seeing much of a difference in the interest rate. The interest rate would be about the same at 7.125%. But where we see the biggest difference is with the mortgage insurance. So instead of a 0.55 mortgage insurance rate, we're looking at a 0.33 mortgage insurance rate, which in this scenario is dropping the payment roughly $50 a month down to $85. So that's where we see the benefit of the conventional for these high credit score borrowers is usually a pretty large drop in the mortgage insurance. And something else I'd like to point out is, having two borrowers on a loan application, the mortgage insurance is typically going to be a lot better for two as opposed to just one. So with FHA, it doesn't make any difference, one or two. And like with the credit score, that usually dictates what the mortgage insurance is going to do with conventional a lot. And so in that scenario, you could have a 680 and a 760 borrower together on the same application. So with that scenario, the interest rate pricing is going to be based off the lower credit score of 680. So that's the interest rate. But on the mortgage insurance, it's basically blended. So in that scenario, the mortgage insurance actually isn't going to be too much worse than if you just had a single 760 borrower by themselves, or it might even be a little better just because there's two on that application.
Well, Alex, saving money is saving money, but, I was expecting to see, a much bigger difference running this scenario. So I'm really impressed with how the FHA loans are shaking out across these two scenarios here. Obviously, the other was much more significant, but really painting FHA loans in a very different light for me today, hearing all this information.
Yeah, FHA loans are fantastic mortgages, ones that, are suited for a lot of people. And, I think a lot of people think of them again as first-time homebuyer or just for a worse borrower, but it's still an awesome option, even if you're well qualified with a 720 credit score, lower debt to income, all that. It might end up still being the better option, especially if you're making that minimum down payment. Because when you make a minimum down payment, it's going to be a long time before you get to that 80% loan to value mark anyway. It might be 7-8 years before you actually get there. So within that time frame, a lot of people, don't even stay in their homes that long. But there's also going to be opportunities,
refinance.
The opportunity to refinance and start out in an FHA mortgage. But after time, maybe you improve your credit and it ends up pricing out better with a conventional. So you refinance into a conventional. And like we talked about, with that one, you're going to be able to get the mortgage insurance removed at some point.
Great points all around. Anything else that you want to leave us with, maybe that we didn't discuss today?
I think one thing I wanted to point out, so with conventional, you have the mortgage insurance. So for those borrowers that are taking on the conventional, one thing to keep in mind, when you are getting to that 80% loan to value mark, you need to call the loan company and ask them to remove that mortgage insurance. Because in a lot of cases, the loan companies will not actually remove it until it gets down to 78%. So they'll automatically remove it at 78% loan to value, but there's no reason to wait. I don't know why they set it up like this, but definitely worth making the call to eliminate that mortgage insurance if you're at that 80% mark.
100%. And speaking of somebody who has done that, did that with our house in North Carolina, they also take appreciation into consideration. So you might be at 75% and it could be worth a call.
Right.
I think they charge you around $400. They do a broker's price opinion or have a local agent that they contact, drive by, pull some comps, tell them what they think the value is. And it's on the value of your house that day. So even if you haven't physically paid the principal on your mortgage down to 20% of what you've borrowed, they will often take today's value and then compare that to the principal that's still outstanding, which might get you to 80% faster than you think, especially if you're in an area of high appreciation and a lot of growth.
Definitely. Yeah. For areas that have seen a lot of appreciation like that, if someone bought a home 3 years ago, they could have bought it with a minimum down payment. And at this point, it might already be at 80% loan to value, even though based on the original appraised value that they got when they got the loan originally, it might only be at 90, 95, somewhere in that range. Now that home values have gone up so much, and they'll likely continue doing that, there's going to be a lot of opportunity to get that mortgage insurance removed well before the original point would have been based on the original appraised value.
I love that. Love when the numbers work in our favor.
Oh yeah.
Well, Alex, thank you so much for being on the show today. Please tell everybody how they can find you and what states you serve.
Yeah, so I've got a website. I'm on Facebook, Instagram, all those places. You can find me there. I am licensed in Indiana, Kentucky. That's where I do the majority of my business, but also North Carolina, Florida, and Georgia. And then my company, Interlinc Mortgage, we do business in about 20 states. So if I can't help you personally, then I can most definitely connect you with someone if you are buying in one of those states. So yeah, a lot of options and a lot of people we can help across the country.
And I highly recommend Alex. He has been on the lending side of a number of transactions that I've been involved in, help a number of my buyer clients. He's been known as a little bit of a miracle worker. Typically, his interest rates are a little bit lower than others, and other people who have been essentially turned down by the lenders saying that they can't help them, he's found creative ways to be able to do so. Really, really gets involved and tries to make everything work. So if you feel like he can be of value, if you're in one of those states or even, one of the 20 states the Interlinc serves, please reach out to him, Alex Turner. Thank you all so much for joining us today. We're going to be back very soon with another thought-provoking real estate episode to help you win in the real estate market.
Thank you, Jonathan. Great to be here today.